Namaste, welcome to Arthaniti. Rising prices have become worrisome. Yesterday, the wholesale price index rose to almost 14.55%. The CPI, the retail price index, clocked 6.95% for the month of March. Prices are going to be on a higher side given the ongoing Russia-Ukraine war, the supply chain crisis because of China lockdown, and various factors all over the world, right? What do you do? How do you manage your investments? How do you manage your finances so that uh, you get a good enough handsome return on them? Now, it is always said that not all your money should go into one particular financial product. You have to have a basket of investments to make a healthy portfolio. Some of your money should go into fixed interest giving investments. Some should go into riskier investments so that they give you better returns. Some should be for long term, some should be for medium term, some investments should be for specific goals that you have in mind, right? So, see, let us look at this one fixed interest earning investment, which all of you should do in these current times of rising prices. Now, as I told you before, the retail inflation stood at 6.95%. Our aim when we invest our money is to earn a post tax return which is above the inflation rate. Why do I keep on saying this? Well, this is done if you achieve that much return on your investment, the value of your money will grow. Otherwise, the value of your money will reduce over a period of time. Correct? You will be able to buy less items with the same amount of money if it is not growing at a higher rate than the inflation rate. So, today, what I'm going to tell you is that investment product which will give you tax free returns which are higher than the inflation rate. All of us have heard about PPFs, public provident funds. Let us dig into what public provident funds are. Let us bust some myths. Let us have a clarity about this particular investment product today. Let us have a clarity about this particular investment product today. Let us have a clarity. Let us simplify PPF. Let us bifurcate it into 6 different points and I'll explain you each point separately. First thing, let us start with the amount that you can invest. Now, the minimum investment that you need in a PPF account is 500 rupees. Maximum limit is 1,50,000. So, from 500 rupees to 1,50,000 rupees, you can invest any amount every year. Correct? Can you invest more than 1,50,000? Well, if you do, the excess amount above 1,50,000 rupees is not going to attract any interest. So you will not earn anything on that excess amount. So no point in investing more than the limit that is given. Now, if you plan to invest in PPF in the names of your minor children, the contribution that you make to your minor child's PPF account will be clubbed with your contribution that you make to your PPF. So together, the sum cannot exceed 1,50,000. Correct? What you can do is you can invest a separate 1,50,000 rupees in your spouse's name. So if you invest in your children's name who are minor, that amount is going to get clubbed with your contribution. But additional 1,50,000 rupees can be invested in your spouse's name. Correct? Understood? So minimum 500, maximum 1,50,000 for 1 year. Now, if you do not invest that minimum 500 as well in your PPF account, what is going to happen? Your account will become dormant. A fee, a penalty of 50 rupees will be charged to you to make your account active again. Correct? Let's go to the second point, which is interest. Now, as I told you, in these periods of rising prices where inflation has reached 6.95%, we should be targeting returns which are higher than the inflation rate. PPF gives you a return of 7.10%, which is obviously higher than what the current inflation rate is. So is this the rate which is fixed for the whole period of your PPF account? Well, no, PPF rates are not fixed. They are assured. The interest is assured, but the rate of interest is not fixed. Does that mean it changes on a daily basis, monthly basis? How does it happen? Well, PPF rates are announced by the government at the beginning of every quarter. They are based on the 10-year government bond yields, and every 3 months, the returns from those bonds are reviewed, and on the basis of that, PPF rates are fixed. So for the quarter April to June 2022, the rate that was announced is 7.10%. Now this has been the rate for some time now, but every quarter the government can change it based on the performance of the bonds in the previous 3 months. Understood? So PPF rate not fixed but assured. Currently at 7.10. Right. Now the third thing, we spoke about amount, we spoke about interest. The third point is tenure. All of us know that PPF has a maturity of 15 years. Does that mean that the money that you invest in the PPF cannot be withdrawn before the end of maturity? Is 15 years the lock-in period for your PPF account? No again. 15 years is the maturity period. Is there a lock-in period then? Yes. 6 years is the lock-in period. You cannot withdraw money from your PPF account for the first 6 years. At the end of the 6 years, partial withdrawal is allowed. Now on maturity, do you need to close down your PPF account and take all the proceeds that have accumulated over a period of 15 years? Can you not extend the PPF account? You can. Extension of PPF accounts is indefinitely possible. You can extend your PPF accounts in blocks of 5 years each for an indefinite period of time. What happens is, after 15 years, after the maturity, you need to inform the bank or the post office where you have your PPF account that you intend to extend it. If you are going to keep on contributing to that account, you need to inform it to the bank or the post office. If you do not inform about your intentions to contribute to your PPF account, the bank will not accept contributions after a period of 1 year. So your PPF account can then have only the amount that you have accumulated in the first 15 years. So in case you intend to keep on investing in your PPF after the maturity of 15 years, be very clear that you need to go to your post office or the bank where you have this PPF account and inform them about your decision of extension and investments in the PPF accounts. Correct? So can you withdraw money from PPF? Yes, as I told you earlier, partial withdrawal from PPF is allowed. When can that be? After the end of 6 years. How much amount can you withdraw? Well, 50% of the balance that has been accumulated in your PPF account at the end of 4th year or the year immediately preceding the year of your withdrawal, whichever is less, is allowed as withdrawal amount from your PPF account. Now, say for example, you want to withdraw some money at the in the 10th year of your PPF account. So how much will you be eligible? Well, 50%, half of the balance that has been accumulated in the 4th year and 9th year, the year immediately preceding the year of your withdrawal. So of the two, whichever is less, half of that amount you will be eligible to withdraw partially from your PPF account. Can you foreclose your PPF account? Yes, you can. After 5 years, in case you do not wish to continue with your PPF account, or you need money, say for some emergency situation in the family, some medical expenses or a marriage in the family, you need the money, you can foreclose your PPF account. But you will be paid 1% lower than the prevailing interest rate. So the current interest rate is 7.1%. You will be paid at 6.10% for the money that you get from your PPF. So that is a significant reduction in the returns on your PPF. So only foreclose your PPF in case of extreme emergency, right? The fifth point is about loans. Can you get loans on your PPF? Yes, again, you can get loans on your PPF balance. When can you get it? During the period from 3 years to 6 years, you can get loan on your PPF. What is the amount of loan that you can get? Up to 25% of the balance in the previous year when you are taking the loan will be an eligible loan amount for you. Say suppose you want the loan in the 5th year of you opening a PPF account. So 25% of the balance that you have in your PPF at the end of 4th year will be your eligible loan amount. What is the rate of interest that is charged on your loan? 1% higher than the prevailing rate of interest. So prevailing rate of interest is 7.10. You will be charged 8.10 on the loan that you have taken. What is the duration of the loan? 36 months, 3 years. You can take this loan for 3 years and repay it before the end of the 3rd year. In case you fail to repay the loan at the end of 3 years, a penal interest of up to 6% higher than the current rate of interest on your PPF will be charged. So current rate of interest 7.10 plus 6%. So your loan will be charged at 13.10% in case you fail to repay it before 3 years from taking the loan, right? So it is available, but then again, the maturity period is just 3 years. Very necessary to keep in mind. The sixth and the last point is about taxation. Now, most of us open PPF accounts for tax deduction purposes. Up to 1,50,000 rupees that you have invested in your PPF, you can claim deductions under Section 80C of the Income Tax Act. Now, if you are investing in your children's name together, only up to 1,50,000 rupees per person is available as deduction under Section 80C. If you are investing in the name of your spouse, the spouse in his or her return can claim deduction for the contribution that has been done in his or her name separately, correct? But for one person, tax deduction is available up to 1,50,000 rupees. Again, as I said, in these times of rising prices, you can take advantage by investing in your name as well as your spouse, in the name of your spouse. So you can invest up to 3 lakh rupees and earn interest which is higher than the current inflation rate. Now, the best advantage of PPF is exempt. So the amount that you invest is exempt from tax. The interest that you earn from PPF is exempt from tax, and the amount that you withdraw or the maturity proceeds that you receive from PPF again is exempt from tax. So this is the beauty of this product, and that is why full advantage of this product needs to be taken when you are bifurcating your portfolio into fixed interest earning securities, risky securities where rate of interest is not fixed. So for that portion and for a longer duration of time, this is one of the best products that you have in the market. You should take advantage of this product and deposit the maximum money that is eligible for investments in this product. I hope that you have liked my video. In case you have any queries about PPF, please feel free to comment below the video and I will be happy to help you to the best of my knowledge. Like my video, share my video, and subscribe to my YouTube channel for more such valuable inputs in your investment journey. Thank you.